Good afternoon, everyone. Welcome back to Business Law 2. Today we're going to be looking at Chapter 46, which involves securities regulation. And in terms of the overall learning objectives for this chapter, I want us to be able to understand the nature of securities regulation. We'll talk about the Securities Act of 1933 as well as the Securities and Exchange Act of 1934. That provides the overall kind of like framework for most of the modern kind of like securities regulation that occurs in the U.S. We've added to that legislation with other pieces of legislation, but these are the two kind of predominant kind of like laws at the federal level of government that regulate securities types of transactions. We'll talk about liability under securities laws, and then near the end of the chapter, we kind of delve into some issues pertaining to insider trading. So that's going to be the overall focus for this chapter. Anyway, the regulation of securities is a great example of federalism. If you recall back from Business Law 1, we talked about, like, there was a chapter where we studied the Constitution of the U.S. government. And we talked about federalism as a structure, which is the sharing of power at the national and the state level of government. And so this is an example of securities regulation where, even though predominantly the focus is at the federal level of government, there are state level regulations that pertain to securities and transactions involving securities. So they do kind of coexist together. They're not always complementary, even though we've tried to kind of, sync them a little better in recent years. But when you talk about state laws that exist pertaining to intrastate securities, so, there are some, corporate forms of businesses that exist just within a state. They don't do any, type of interstate transactions. It's all just within a state. Those state laws that regulate those types of securities transactions are called blue sky laws. And so if you happen to see that in the textbook or in some other reading, that's what that's in reference to. Again, even though state law varies, because, we have federalism, so states get to kind of experiment and do different things. Some of the common elements to blue sky laws nationwide is obviously a prohibition on fraudulent practices, broker-dealer licensing provisions. So, there's like a licensing process to maintain the integrity of the profession. Provisions for registration of security, types of transactions, and that includes disclosure requirements. Usually, again, the focus is trying to maintain investor confidence, so that if you do decide to purchase securities in a company, you know that the representations that are being made are valid and not, unscrupulous or fraudulent or criminal in some cases. The National Securities Markets Improvement Act of 1996 Congress decided to try and address some of these overlapping legislative frameworks by allocating responsibilities, so that, again, it's not a perfect kind of like puzzle that kind of fits together, but they wanted to try and have these blue sky laws sync a little bit better with federal law, so there wasn't too much of conflicting legislative provisions regarding the regulation of securities. Until 2002, the two principal laws that governed the federal level in terms of regulating the sale of securities in interstate commerce were the Securities Act of 1933 and the Securities and Exchange Act of 1934. And as you can see here on this slide, the original distribution of securities by issuing corporations, the registration statement, the prospectus for potential purchasers, those were really the topics that were covered under the 1933 legislation. If we're talking about the sale of securities from one owner to another, and for corporations that have assets in excess of $3 million or 500 or more shares, then that would be covered under the 1934 legislation. Remember, again, not to get too bogged down in like U.S. history, but prior to these two pieces of legislation, like in the early 1900s, the teens, 1920s, companies were allowed to just issue shares, and there was no federal oversight. Some states had some limited oversight, but again, it was this new thing. this idea of economic activity, industrialization, transformation of society from rural to urban, settings. And now we had this new corporate kind of business form that raised money by selling shares of a company to the general public. I mean, it was an exciting time, but it was fraught with a lot of misrepresentation, a lot of fraud, a lot of deception. And so, part of what kind of precipitated the stock market crash in the late 20s and how it kind of accelerated into the 30s was the fact that, all these companies were selling shares of stock that had no basis in valuation. They would just say, we need money, so let's just sell stock. And so, there was no underlying or representative value saying that, well, these shares are based on assets, or they're based on inventory, or they're based on some identifiable, linkage to value other than just what we say it is. So like with anything, a crisis occurs, the depression happens, and then there's pressure put on Congress from individuals across the country. We have to have a system where we can have faith in the investing public. Otherwise, it's game over for our capitalistic system. And so that was the push to kind of enact these two pieces of legislation. So, we go through much of the 20th century, and these two pieces of legislation is the predominant focus for securities regulation. We get to the early 2000s, and again, another scandal occurs, this time with companies such as Enron and WorldCom. And so pressure again is put on lawmakers at the federal level of government to create a framework that augments oversight by the Securities and Exchange Commission on the corporations that exist across the country. So Sarbanes-Oxley, or sometimes just called SOX, is what was enacted in 2002. This reformed, this idea of corporate accountability. It enhanced disclosure requirements. It required like independent auditor and accounting provisions. It beefed up enforcement. It beefed up liability provisions. And so it again, the goal was to try and encourage and foster more faith by the investing public in these companies. One example, which a lot of people really didn't know occurred prior to the Enron and WorldCom scandals, was this idea of personal loans being floated to executives in corporations. And so, obviously, there's always, financial incentives to lure executives from one company to another, stock options, all that stuff is fairly transparent. But what a lot of investors didn't really understand was that, if you wanted to lure, let's say, a CEO or some other executive, CFO or something, from one company to another, in addition to salary, in addition to, profit sharing or some sort of stock incentive program, they would also offer personal loans. And if you stayed with a company for a certain number of years, or if you kind of met certain targeted benchmarks, the loan would be forgiven. And, these were not loans like, for like $10,000. We're talking multi-million-dollar loans. And on the books, because, technically all of these transactions are transparent through, income statements and spreadsheets that get submitted to the SEC for public review. But these transactions were being masked and kind of hidden or concealed from investors. And so they didn't really understand the level to which, a lot of these personal loans were being kind of floated to lure people in, and then these loans would just be forgiven. So SOX, one of the other things that it did was it put an end to all of these kind of sweet, kind of like, preferential private or kind of like hidden loans that were being made from companies to other executives to lure them there. So, that's the experience of Enron and WorldCom. Another scandal, not quite to the level of the Great Depression, but, still a scandal nonetheless. And so we look to lawmakers to try and fix this through regulatory enhancement. We get to 2008 and the financial crisis, the meltdown that occurs within the mortgage and the financial markets. Again, this is not quite the Great Depression, but it's much more significant than Enron and WorldCom ever could have imagined. And so more pressure is placed on Congress. And so what was enacted was the Dodd-Frank Wall Street Reform and Consumer Protection Act. And so again, this consolidated some regulatory agencies, especially with the Securities and Exchange Commission. It gave them greater power to investigate, greater power to kind of seek transparency in the traditional as well as these alternative or derivative markets in the financial sector. And again, trying to increase consumer and investor protection and rights, put restrictions on depository banks and their ability to invest in these private equity or hedge funds. There was this phrase from this era called "too big to fail," and so that really was the focus. Was we wanted to avoid having these mega, kind of like Goliath type financial corporations, where that if they did fail, it would just be totally destructive on the U.S. economy. So these corporations knew they could do anything they want, and the federal government would end up bailing them out, which is what they did essentially, in 2008, 2009 with those different stimulus packages. But with Dodd-Frank, the goal was to try and manage and distribute, the risk and make it more manageable, make things more transparent, and reduce, hopefully, the likelihood that another, great recession-like event could occur in the United States. Regulation, and we've talked about this in different contexts, but regulation kind of ebbs and flows throughout U.S. history, especially during the 20th and now 21st centuries. Regulation is labeled as like a bad thing, by Republicans. It becomes a political thing, unfortunately. Democrats looked at regulation as a way of trying to keep, companies honest and protect, the general public or consumer. And so, the farther we get away from, a kind of like an event that, where people demand regulation, the farther away we get from that, then the more it's like, let's loosen up the controls, let's deregulate, because that's going to free up the economy, it's going to allow businesses to grow and thrive. And invariably, if history is the predictor of the future, what's going to happen is, as we ease regulations, there will be a crisis, and then we'll kind of return back to increasing regulation. It's a cycle that we seem to go through. I think if we, most companies do what's right. They do the ethical, the honorable thing, but it's always the small number of companies or the small number in any group that makes the majority look bad. And I think if companies were better at policing themselves, then I think we could avoid a lot of these regulations that get enacted. But, it is what it is, I suppose. Anyway, when we talk about the term securities under Dodd-Frank, that's stocks and bonds issued by a corporation, but it also does include what are called investment contracts. An investment contract requires three essential things. So it has to be an investment of money, it has to be in a common enterprise, and there has to be an expectation of future profits from the efforts of others. So an investment contract is really a very wide open kind of like concept that's open to regulation now. I think everyone, they get what stocks are, you get what bonds are, but an investment contract, technically that could be a group of individuals who want to pool their money together to invest in, let's say a condo in order to rent it out, to individuals, because that's an investment of money, it's a common enterprise, and the hope is to make profit. So, the federal law can regulate on a micro level, like 2 or 3 people that buy a condo on the beach to rent it out, and it seems kind of unusual to think of it like that. But that does come under this idea of a security that's subject to regulation. Criminal and civil penalties, obviously, for fraudulent statements, that has been beefed up and augmented under these different pieces of legislation. With the Securities and Exchange Commission, the SEC, they're the ones that administer both the 33 and 34 Acts, as well as SOX, Sarbanes-Oxley. And the purpose of the SEC is to ensure adequate disclosure by companies, to facilitate investment decisions by the public. So, again, maintaining investor confidence. Investors, all they want is the straightforward, honest information, and then they can make an informed decision. Then, do I want to buy into this company or not? So that's really the focus with regard to the 33, 34 Acts as well as SOX. The Federal Trade Commission, along with the SEC, enforces Dodd-Frank. So those pieces of legislation that came into effect at the end of 2009, 2010 because of the Great Recession. When we look at Section 10b and Rule 10b in terms of the federal legislation, that's what's concerning the topic of insider trading. So trading on inside information is unlawful, and it's going to be subject to civil penalty of up to 3 times the profit made on improperly disclosed information. So when we try and think of who's an insider, so obviously a director or corporate employees, they're going to be liable. It also includes what are labeled as temporary insiders. So that could be an attorney that's providing maybe on a contractual basis, maybe some legal services. Could be a CPA that's doing auditing or some kind of accounting services or bookkeeping for a corporation. And so usually with insider trading, there is a tipper. That's the person who has gotten access to information. And then the tippee is the one who has received that information. And what then are they doing with that information? So the tippee is the one that receives the information, and technically they're not going to be liable if the insider does not breach a fiduciary duty. And so if you recall back a few chapters ago, we talked about what it means to have a fiduciary obligation. But as long as the tipper does not have a fiduciary duty, then if the tippee receives this information, then they're not going to be liable at that point. There's still going to be fallout on the tipper, but the tippee is what we're looking at here. The tippee can be found liable if there is a fiduciary duty that is breached. When you think of the different type of tippers that could occur, let's say you're an attorney for a corporation, you have a fiduciary duty, no question about that. And if you share information with, let's say, a secretary, a friend, a stranger, doesn't matter, you're going to be responsible or liable, as well as the tippee who acted on it, because the fiduciary duty was kind of violated there. If let's say it's a custodian in a corporation, and they happen to just see a memo in a trash can, and they happen to flip through it and realize that, hey, something's going to happen that's either going to increase the stock or decrease the stock dramatically, and they tell someone and that other person acts on it, well, custodians don't have a fiduciary obligation. I mean, they're just there to clean. So that's where, again, the SEC, they keep track of all these anomalous type transactions that occur. I mean, when you buy and sell shares of stock, or bonds, all this stuff is public information. And if something, if there is any significant transaction that occurs, and then there's a significant change, either up or down with regard to that share price, that's going to be flagged by officials at the SEC and the FTC, depending on which law is being enforced, and they'll investigate further. And so they'll contact the person who's making these transactions. Where did you get this information, or was it random? And if it's a small transaction, you might actually get away with it. But technically, this is the standard that we're looking for. You're not supposed to trade on insider information. Many of you remember the case involving Martha Stewart, probably well over 10 years ago now, almost 15 years ago. And she got in trouble with the Securities and Exchange Commission because she received insider information about something that was going to happen with one of the companies she owned stock in. And the decision was going to lower the price of this company's stock. So she panicked and she sold these shares. Well, what happened? Soon after she sold, the stock dove, in terms of the price, and then she gets contacted by lawmakers. And, the fact that you're a tippee, because that's what Martha Stewart was, she was a tippee, she received this information. It doesn't necessarily mean she's guilty of anything or liable of anything yet. What got her into trouble more than anything was that she lied to regulators and she tried to destroy and tamper with evidence. And now you're tampering and you're kind of obstructing a federal investigation, and that in and of itself is a crime. So that's ultimately what got her in trouble, and what ended, her up going to prison was the fact that she lied to investigators and she was tampering with evidence. That was much more of a glaring problem than the fact that she sold some shares of stock in a company that was not doing so well. Let's see, in terms of ownership disclosure, so disclosure statements, those are always filed with the Securities and Exchange Commission, and that's required by corporate officers, directors that own equity securities in the corporation they work for. Shareholders also have to file a disclosure statement if they own more than 10% of any class of a corporation's equity securities, so common or preferred stock, for example. Any of those above people, so directors, officers, or those significant shareholders, 10% plus, if they sell securities for a profit less than 6 months after acquiring them, they may be guilty of making what is called a short swing profit. And in that case, if they're found to be guilty of that, the corporation can actually recover those profits, even if there was no fraudulent intent. So, I mean, you have to be careful if you're one of those directors, officers, or shareholders. Wait past the 6 months, and then, okay, fine, just don't trade on inside information. What I've seen a lot of in larger corporations, what a lot of directors or officers will do is that maybe regularly they will sell some shares of stock in the company they have, because that's part of the shares that they get as an incentive. And, again, you can alert your, through the disclosure statement and then through your stockbroker. It's like, okay, I regularly want to sell, whatever number of shares of stock, per year as a way of augmenting my income, because maybe you don't get as much salary. There's different ways in which executives are compensated. So, again, if you're above board, if you're transparent, if you disclose everything, you're going to be fine in almost every case. That's always the big takeaway to remember with this is, always, be transparent, and you can avoid so many problems that way. That actually was the last slide for this chapter. So if you do have any questions, as always, please feel free, to message me. You can call, text, or email, and I'll be happy to get back with you as soon as I can. But have a good, safe, and productive rest of the day, and I'll be chatting with you all online. Thank you so much.